Yeah, hi guys. Let's just see the global and Indian market intelligence Google Sheet. So once you make the successful payment, you will be redirected to this page. So if you just click on make a copy, it will be copied to your Google account. It will just give you a quick overview of each Google Sheet. So just wait for a couple of minutes to load to all the latest data. So the first one is that global index, so it will show all the major indices and their in each country and their major indices. For example, in India we have the Nifty and Sensex. Similarly, we have benchmark index for each countries, so that will be listed. So you just listed all the available countries here. So the left side will just focus. So the main market, the mother of all market is America. So we just include the Dow Jones Industrial Average and S&P here, and then the 1 year Dow Jones chart on the left side. And then let's say if you move on to the right side, so it will show all the major available countries and then the currency depreciation for each country. So in this case, Dow Jones has USD currency, so the USD INR pair. So basically this 9.5% indicates the INR depreciated 9.5% against the US dollars. So that's the for each country how much the INR has been depreciated. See, the Brazil has depreciated 20% in the last 1 year. That means if you have invested if you had invested in Brazil currency, not in any stocks, you would have just got 20% return. So that's what this column indicates. And then there 1 day, so the 1 day return indicates the Dow Jones Industrial Average 1 day return, and then 1 month return, 1 year, 3 years, 5 years, and then the change from 50-week high, and then change from 50-week low. So this is that all the columns. So if you take an example, so here in this case the INR depreciated 20%, and also the stock market in INR in Brazil benchmark index given a 37% return. If we combine them both, we have gotten 57% return in a 1 year in Brazil if you had invested in Brazil. So this is like a global eye view, so how the major indices has been performing in the last 1 year and 5 years. So based on that we can able to take a decision on that. So if we compare that to Indian market, the Indian market 1 year return is negative 1.2%, which is, and also it is the currency has been depreciated hugely against all the currencies. So here, so yeah, so that's why the FA have been moving out of the Indian market, I guess. So yeah, that's a speculation, I guess. Yeah, let's move on to the next thing. So the next thing is the US sector and industry indices. So this is for the US market. It will cover all the major sector, S&P sector, and their change, and then 52-week high, low. Same goes for the S&P industry. This how the bank in US performed 1 day, 1 month, 1 year, 2 and 1 year and 5 years, 52-week and 52 as usual. So we just listed all the major sector and the indices here. And then if you move on to the next if you come to the next Indian market, so it's the same. We have the Sensex and Nifty, and then the Nifty 1 year chart, and then we also listed Nifty 50, Sensex, Midcap 100, 200, Nifty 200, and Gold Bees for reference, and then they are relevant return in 1 year and 5 year time frames. Yeah, that's basically on the Indian industry. And then same goes for the Indian sector index. So you just also included the commodity, and then crypto for some look into that. So basically a global eye view, so you can able to just view all the major points in a single sheet instead of going and searching for each. So if you want to know about the gold price, you can just look up it into this, or else if you need in traditional sense, you have to go to the Google and then search gold bees, and then you need to get the return. Here you can just able to get a quick view of all the major indices and then the commodity and bond prices here. So that's basically it. And also you can also list the Indian indices, bank Nifty, auto sector. So basically all the major sectors here, and then their relevant returns based on 1 year, 1 month, 3 years, and then their change from 50 to high and low. So if you see, we had just given you the world view. So first we go into the global, and then we just look into the US sectors, and then we come to the Indian index, and then we come to the Indian sector. Next, the next step is to individual stocks. So it's like a global view. So macro, and then the global, and then the micro, which is stocks. Basically you can just able to click, you can able to see all the stocks. You can able to change it, and then add a new stocks here. If I just add so you can just able to add a new stocks here. If you just add HDFC Bank here, which it is saying, you can just able to click either it is some large cap or mid cap, and then the sector. So here it's bank. Maybe I can show in the finance column here, financial. So this is basically, if you click on this sector and large cap, it will it will calculate that margin of safety here. So this is the this is the margin of safety formula given by Benjamin Graham. So this is the formula we use. So basically we have that EPS for each stocks from this column. So if you see that the EPS, so there is a 48.34 EPS, and then we also have a PE here and market cap, and then so I'm just trying to calculate the intrinsic value here based on the Benjamin Graham formula, based on the bond rate and AAA corporate bond and so on, and then I'll just calculate the intrinsic rate, intrinsic value, and then compare it to the current price, and then I calculate this margin of safety. In this case, the HDFC Bank has 68% margin of safety because it's corrected a lot in the last 1 year, and also there is some recent issue has been going on, so I think that's why it's corrected huge. Yeah, so that's how we can able to. So in the traditional sense, you have to calculate this by hand or manually or an Excel sheet. For each company, you have to take all the thing, and then you need to look into that each company's growth potential and PE, and then you need to apply that formula for again and again. So even if you do that, you can able to track that in 1 year or 2 year time frame, so it will be long forgotten. So that's why I just created this for my personal use, so you can able to see quickly what are all the margin of safety for in that particular time. So in this case, the market opened, I can able to get the real-time view here. So that's how the thing looks like. You can able to also filter it out. If I just filter this by margin of safety, if I just Z to A, maybe I can just remove the zero quantities and then add this filter. So I can just able to what's that margin of safety in descending order. I can able to get. So this is over highest movement logistics is overly high valued because it's the P is 446. But for a logistic company, we're giving a 446, which is huge value, so that's why it's red. It's negative 600%, so it's like 6 times expensive. Same goes for the iris. So here in this, sometimes it may so disclosure, it's sometimes it may or may not be wrong. So here this iris rich tech, right? So it gives 95% margin, but it has an other income of one-time other income of so that's why it's the PE is too low, because in the last quarter it has another income. That's why it's so it just take it as a grain of salt, because we can't able to get that exact gross margin, gross profit here. So the same goes for the Senco Gold. So you can able to just get a quick view of that percentage, and you can able to select the stocks, and then you can able to deep dive into that particular stock, and then whether it's worth the while to study that much or week or so. Yeah, that's it. And then so if you want to play around with this margin of safety, you can able to change this industry PE and then expected growth rate here. That will be automatically that will automatically reflect here. So let's just say if I'm just if I'm assuming that IT industry is down right now, so I'm just reducing this industry PE, let's say 15 as a base PE, and then expected growth is like 60%. So it will be automatically reflected here. The IT, so all the IT sector will be reduced, will be calculated based on that particular industry PE and then the expected growth. You can able to also play around with it, and then you can able to get that, and then you can able to manually change this bond rate or corporate bond rate on 10-year bond yield. Based on this, it will also be changed this margin of safety column. Yeah, so full disclosure. So it's full disclaimer. This is all entirely for educational purpose. I'm not a registered advisor. You need to take a deep dive. So this is all for educational. So any stocks or PE or assumption is mainly focused on giving educational purpose, not a stock recommendation or anything like that. Yeah, thank you. Yeah.